The Federal Reserve's December rate cut, once viewed as almost guaranteed, is now clouded by uncertainty as new data reveals a complicated and uneasy economic landscape. Inflation, although lower than last year, continues to resist the level of cooling the Fed considers safe, especially in areas like rent, services, and everyday essentials. At the same time, the job market is showing clearer cracks. Hiring has slowed, participation rates are slipping, and several industries are quietly reducing the pace of new roles. Public reports show stability, but beneath the surface, businesses and analysts are increasingly cautious. These opposing forces have pulled the Fed into a difficult position. Cutting rates too soon risks reigniting inflation, while delaying a cut may add stress to an economy already showing early signs of fatigue. This tension has reshaped the tone from Fed officials. Just months ago, they spoke with growing confidence about progress. Now, the language has shifted into something more guarded. Some members of the Federal Open Market Committee argue that inflation progress has stalled, while others say the job market may no longer have the strength it once did. This internal divide is significant because when the Fed signals uncertainty, markets respond quickly. Investors who once felt assured about a December rate cut are now divided, with some preparing for a possible delay. These mixed signals have created a tense debate inside the Federal Reserve. Some officials argue that inflation progress has stalled and that cutting rates too soon could undo months of effort. Others warn that weakening employment, shrinking hours worked, and declining job openings show rising economic strain. This internal divide has led to a noticeable shift in tone. Gone are the confident statements about steady progress. Instead, the language has become cautious, measured, and deliberately unclear to avoid sending premature signals to markets. This uncertainty matters because interest rates influence nearly every financial decision families and businesses make. A reduction in rates lowers the cost of mortgages, auto loans, credit cards, and business borrowing, potentially boosting hiring and spending. But keeping rates higher for longer could slow the economy further, forcing companies to freeze wages, delay expansions, or cut back on staff. The stakes extend far beyond the financial markets. They reach into household budgets, job security, and long-term economic confidence. Investors are also reacting to the tension. Some see signs of an economic slowdown that could justify immediate rate cuts. Others worry that inflation will flare again if the Fed moves too quickly. This split has created sharp market swings as traders try to interpret every speech, every report, and every small adjustment in official comments. Even slight shifts in phrasing are analyzed for clues about what the Fed might do next. Making matters more complex, global economic conditions are adding pressure. Slowing growth in Europe, fragile manufacturing in Asia, and ongoing supply chain adjustments all contribute to the uncertainty. The U.S. cannot fully insulate itself from these forces, and the Fed must consider the international context when deciding how aggressively to act. As the next scheduled meeting approaches, analysts are watching three key indicators: inflation trends, job market stability, and consumer spending strength. If inflation softens further while employment weakens, a rate cut becomes more likely. But if prices remain firm or rebound slightly, the Fed may decide that holding rates steady is the more responsible choice, even if it risks greater economic discomfort in the short term. For everyday people trying to plan their future, whether buying a home, starting a business, or simply managing monthly expenses, the situation can feel unsettled. The path forward depends on how the Fed interprets the conflicting data and how much risk it is willing to accept on either side of the equation. However, each rate cut carries significant risks. Lower interest rates make loans cheaper, which encourages consumers to borrow more and businesses to expand. This can boost job creation, stimulate the stock market, and increase the availability of credit. Yet, there is a trade-off. When borrowing becomes easier, money flows faster into the economy. Demand rises, and when demand grows too quickly, prices tend to follow. That is how inflation can reignite. The Federal Reserve must move carefully because cutting too aggressively could cause inflation to accelerate again. This would erase years of progress and might force the Fed to raise rates later, potentially harming economic growth even more. Adding to the complexity, global factors also exert pressure. Energy prices fluctuate, supply chains remain unpredictable, and international conflicts can drive costs higher. While the Fed cannot directly control these external pressures, its policy decisions are inevitably influenced by them. At the same time, the central bank monitors domestic indicators closely, including consumer spending patterns, credit card debt, and housing demand. These signals help policymakers determine whether households are financially healthy or struggling under mounting costs. The Fed's dual mandate, balancing inflation control with support for employment, sounds simple in theory, but in reality, it is a constant juggling act. Every decision involves trade-offs between immediate stability and potential future risks. Each rate cut sends a signal, either that the economy needs support or that inflation is under control. Occasionally, it sends both signals simultaneously, adding to market uncertainty. The latest jobs report has introduced yet another layer of complexity. In September, the economy added approximately 119,000 new jobs, exceeding many analysts' expectations. On the surface, this suggests strength, indicating that businesses are still hiring and that the labor market has not yet cooled significantly. Sectors such as healthcare, government services, and leisure continued to show steady gains, giving the impression of resilience. Yet, a closer look at the numbers reveals a more nuanced story. Even as new jobs were added, the unemployment rate edged slightly higher. Though modest, this increase is meaningful, signaling that more individuals are struggling to find work or are losing jobs. At the same time, wage growth is slowing. Workers continue to see raises, but at a more moderate pace than before. Slower wage growth can gradually reduce household spending power, impacting overall economic momentum. Complicating matters further, some of the employment data is affected by technical issues. Delays and disruptions caused by the recent government shutdown mean that certain survey results may not fully reflect actual labor market conditions. When data is incomplete or delayed, interpreting the true state of the economy becomes more difficult. Policymakers are aware of these limitations and know that the full picture may not yet be visible. Another source of uncertainty is labor force participation. While jobs are being added, not all eligible workers are returning to the workforce. Some individuals have left entirely, while others are taking part-time positions instead of full-time roles. This creates a scenario in which headline job gains appear healthy, but underlying momentum may be weaker than it seems. If participation remains low, future economic growth could slow more sharply than the raw employment numbers suggest. Thus, while headline figures indicate stability, a deeper analysis raises questions. Job growth exists, but it is uneven. Hiring continues, but wage pressures are easing. Strength is present, yet signs of fatigue are evident. This mix of positive and negative signals complicates the Fed's ability to confidently interpret the path forward. Inflation remains stubbornly above the Federal Reserve's 2% target, which is the core challenge. Prices are not rising as rapidly as in prior years, yet they are not decelerating sufficiently either. Essentials like food, housing, and services remain costly. Rent is not falling as anticipated, insurance premiums are climbing, and healthcare and transportation costs remain under pressure. These categories are essential, and their continued high prices mean inflation remains sticky. Some Federal Reserve officials have openly stated that progress on inflation has stalled, a word that carries significant weight in economic policy discussions. Stalled inflation means that the early, easier gains are over. The initial declines in prices that were achieved through previous rate hikes have mostly played out, and now reducing inflation further becomes more difficult. The remaining inflation is deeply rooted in the system. It shows up in wages, long-term contracts, and rents, making it persistent. These elements do not simply fall just because interest rates have been elevated for a few months. The Federal Reserve also watches expectations closely. It is not enough to monitor what prices are doing now. They must anticipate what businesses and workers expect to happen in the future. When companies believe prices will keep rising, they often increase their own prices preemptively. Similarly, when workers anticipate persistent inflation, they demand higher wages to maintain purchasing power. This feedback loop can embed inflation into the economy, creating what economists call a wage price spiral. Once expectations are locked in, it becomes far more difficult to reduce inflation without taking sharp measures that could slow growth or trigger a recession. External pressures complicate matters even further. Energy prices, which are influenced by global conflicts, production decisions, and geopolitical risks, can shift quickly and unpredictably. Supply chains remain fragile after years of disruption. Shipping costs, raw material shortages, and international trade tensions all contribute to higher consumer prices, independent of domestic demand. Even if U.S. consumer spending slows, these global pressures can keep inflation elevated, making it harder for the Fed to achieve its targets. Cutting rates too early could be catastrophic. Lower interest rates make borrowing cheaper, which stimulates spending. Increased spending in an already tight supply environment can reignite inflation instead of slowing it. The Fed understands that losing control at this delicate stage might force them to enact even steeper rate hikes later, potentially damaging the economy more severely than if they had waited. Inside the Federal Reserve, the consensus is fracturing. Officials are no longer aligned on a single course of action. Some still advocate for a December rate cut, focusing on the weakening job market. They highlight slower hiring, declining labor force participation, and the risk that prolonged high borrowing costs could strain businesses, particularly smaller firms that rely on credit to operate. For these officials, delaying a cut could tip the economy into an unnecessary slowdown, stifling growth before it has a chance to stabilize. Conversely, another faction within the Fed is hesitant to act. Their priority is inflation control. They see prices remaining above the 2% target, recognize that progress has slowed, and fear that a premature rate cut would signal impatience. To them, lowering rates now could embolden spending and reignite price pressures just as inflation was beginning to moderate. For this group, waiting is a precautionary move, a way to ensure that the hard-won gains in price stability are not lost. This internal division is not confined to Washington. It has reverberated across financial markets. For months, investors had been nearly certain that a December cut was imminent. That confidence has eroded, with expectations now closer to a 50-50 split. This sudden shift matters because markets are highly sensitive to expectations. Changes in anticipated policy affect bond yields, stock prices, and investor behavior. Volatility rises as uncertainty grows, making the Fed's next move more impactful and risk-laden than ever. Communication becomes a critical tool when policymakers are divided. Every statement, every speech, is analyzed for subtle shifts in tone. Traders look for hints of internal debate or hidden intentions. Journalists dissect every word. Even minor variations in language can move markets, sometimes sharply. For businesses and consumers, this division adds confusion. Companies struggle to plan whether credit will become cheaper or remain costly for an extended period. Investors wrestle with the question of whether to position themselves for a rate cut or brace for continued tight policy. This ambiguity slows decision-making and can ripple across global markets, leading to hesitancy in investment, cautious hiring, and volatility in stock valuations. Currently, two paths are forming for the Federal Reserve, and each carries significant risks. In the first scenario, the Fed holds rates steady in December. This approach emphasizes patience, allowing the central bank to wait for clearer data. Inflation readings have been mixed, showing some progress, but also signs of persistence. Holding rates would communicate a cautious stance. The Fed is not panicking, but remains vigilant. It avoids signaling impatience while giving the labor market more time to reveal underlying trends. The Fed's decisions are not just numbers on a page, they ripple through the lives of millions. Every rate move affects how much you pay for a mortgage, a car loan, or a credit card. It shapes business decisions on hiring, expansion, and investment. It even affects the stock market and retirement accounts, influencing the value of savings and portfolios. That is why the current uncertainty matters so much. Right now, the Fed faces a classic dilemma: act too soon or wait too long. Acting too soon with a rate cut could give the economy relief and support the labor market, but it risks letting inflation rise again. Waiting too long might control prices better, but it could slow growth, strain small businesses, and reduce job opportunities. Each option carries consequences that are felt immediately and reverberate over months, even years. For households, this balancing act can be confusing. Mortgage applications, car purchases, and credit card debt are all influenced by interest rates. Higher rates discourage borrowing, slowing consumer spending. That can cool inflation, but may also reduce economic activity. Lower rates encourage borrowing, stimulate the economy, and boost spending, but risk reigniting price pressures. For families, the difference between a Fed hold and a rate cut can mean hundreds of dollars in monthly payments, long-term affordability for housing, and even job stability if businesses respond by adjusting hiring plans. Investors watch these moves like hawks. Bond markets react immediately, adjusting yields and impacting loan rates across the board. Stock markets fluctuate as traders speculate on how a rate change, or lack thereof, will affect corporate profits, especially in interest-sensitive sectors such as technology, real estate, and finance. Even international markets feel the impact as U.S. interest rates influence global capital flows and exchange rates. The Federal Reserve's challenge is made even more complex by incomplete data. Job numbers have been inconsistent, and inflation readings offer a mixed picture. Some sectors are cooling, while others, like energy, rent, and services, remain stubbornly high. Labor force participation is still not fully recovered, and wage growth shows signs of moderation. This patchwork of signals makes it harder to choose the right path. In essence, the Fed must decide while looking through a foggy lens. Looking forward, the upcoming data releases will be critical. Employment numbers, wage growth, and inflation metrics will determine whether the Fed moves toward support or restraint. Every report could tip the balance. Investors, businesses, and households alike will be watching for the slightest hint of change. One misread number or unexpected spike in prices could shift expectations dramatically, influencing spending, borrowing, and confidence across the economy. In practical terms, staying informed is more important than ever. Watch your local housing market, credit rates, and consumer prices. Observe job announcements, layoffs, and hiring trends in your industry. These indicators often reveal the underlying trends before official reports fully reflect them. Understanding the Fed's reasoning and monitoring these signals can help individuals and businesses make better decisions in uncertain times. The takeaway is clear. We are in a delicate period. Inflation has not fully cooled, and the labor market shows early signs of weakness. The Fed's December decision is no longer a given. It is a calculated choice between two imperfect paths. The outcome will influence interest rates, borrowing costs, investment decisions, and the economic trajectory for months to come. Whether rates are held steady or cut, the consequences will be felt across households, companies, and markets alike. By paying attention to the signs, jobs, wages, inflation, and Fed statements, you can better navigate the uncertainty ahead. Economic shifts are rarely obvious at first. Often, the most important movements happen quietly behind the scenes. This is a time for careful observation, informed decisions, and cautious optimism. The Federal Reserve's next move is not just about policy. It is about shaping the financial future for millions, and the ripple effects will be felt long after the headlines fade. Stay alert, stay informed, and remember, understanding the forces at play gives you an edge in a world where small changes can have enormous consequences.